In particular, it's 3M sliding over 5% after it cut its full-year adjusted forecast. What did you make of the numbers that just came out, 3M and a Caterpillar?
Well, so Caterpillar came in essentially in line, and it's keeping its forecast for the rest of the year. So that's probably, people would be happier if they were going to boost that. 3M
was
looks
already
like
a
a
one-year
real
low for Caterpillar. Like, what did they need to see to not be at a one-year low?
I think the problem is you had such good numbers in the beginning of the year, and you're having deceleration in the second half. And that's and for the industrials right now, with the concerns about trade and everything else, I think that deceleration in the second half is enough to be a problem. You're still growing, you're just not growing as fast. And right now, that's not good enough for this market. They've already started discounting it earlier. I mean, to your point, it was at a low. But I think for 3M, that's such a broad-based industrial that they're coming in with disappointing numbers is probably not a good sign.
Yeah, indeed. But do you feel like stocks are being too punished?
Well, if you think about where the market's been and you think about all the concerns that we had, you had the market go up pretty much straight from June to September. So you started to earnings to come in, you were at highs like 3 weeks ago, and now all of a sudden people are looking at this and going, what's going to be my prospect for next year, as opposed to what have these stocks done for me so far this year? And I think you're starting to get into discounting what's going to happen next year, where you're anniversarying the tax cuts that people had on the corporate side, so you're not going to get that boost. And I think that there are some concerns, obviously, about global trade. There's some concerns about what's going on with China, and I think all of that makes it a little bit problematic right here for earnings. But even though it's good news, it's going to be what's the outlook. It's not going to be about what just happened. It's going to be what do you see for next year.
Well, moving on from industrials, I mean, particularly yesterday, both finance, banks, and home building really took a hit. I'll put up a chart here that's a longer-term vision, but it really shows that automobiles and financials and home building are really taking a hit. Is this indicating where we're going with the economy? Is that an early indicator, or is it lagging?
So you also were raising interest rates, right? So the question is this because interest rates are going up and therefore people don't want to now pay higher financing costs for automobiles or for housing? Or is this a question of the economy is slowing and these are the bellwethers of it? I think that right now there's going to be a tension in between whether or not people are going to look to blame interest rates for that versus the economic outlook, because GDP still looks pretty good and spending looks pretty good. But big ticket items and things that you're running on credit, I think higher interest costs start to become a bigger factor.